Just as in equities, last week we taught us the lesson that even in debt, it's important to book profits at levels which may not be to the best of your liking, but which are a little off those levels. So in a recent video, I had highlighted that on my bond portfolio, on my debt mutual fund portfolio, I've already started booking profits at the 10-year GSec level of around 6.25, which I thought is a lovely 80 to 90 basis points below than what it was a year ahead or a year before. My mark-to-market gains were good. I was expecting, in fact, that with a series of rate cuts, the 10-year GSec benchmark could trend to around 6.0%, but the market threw a surprise. Well, what happened is after the RBI suddenly changed its stance, pumped in liquidity through the CRR, short-term yields crashed, but the 10-year benchmark, it went up in fact from the level at which I booked profits on my debt portfolio, 6.23, 6.25 level. It went up to 6.35, and probably today, after crude prices have risen, after the US-China trade battle seems to have calmed down, crude has gone up, and with that, of course, Government of India bond yield will also go up. I'm somewhat lucky that I booked profit at a lower yield. My mark-to-market gains were pretty good because it's always like this. The market can suddenly factor in new variables. Like, for example, short-term yields crashed, but long-term yields went up. Why? Because people could not factor any more rate cuts after the RBI made a 50 basis points sudden cut. Well, the terminal rate envisaged in the future, it wasn't expected to go down any further. What that resulted is that people like me, so many others, they booked profit, a lot of their positions got covered, yield went up. Now there's no more that much money to be made. It's not on the table anymore. You have to wait for the next cycle of factors. Hence, don't always go for that long-term jargon. Book profits even when they are slightly less than your hopes.